Welcome to FX Options University, recorded live at the International Securities Exchange, the world's largest equity options exchange. Join the industry's top trading professionals as they provide insight and strategies for trading in the currency markets using FX options. FX options are a low-risk alternative to hedging currency moves in any market condition.
The idea in the back of the head is the reserve currency status, and just a change in the U.S. Treasury holdings is by virtue very bad. If it happens very fast on some type of risk problem, risk coming into the U.S. Treasuries because of the U.S. government's irresponsibility, it's very, very bad. And then you'd see that what I talked about earlier, that triple whammy of creating the dollar crisis. The Treasuries would be the first driver. And then obviously the dollar would be going south as the treasuries are being sold, and I think you'd see kind of a general move out of the U.S. economy. But it doesn't have to be that way, in that if we get a global rebalancing and the U.S. savings rate actually increases to 10% of GDP, which is about, right now, that would be about $1.4 trillion of domestic reserves created by the U.S. savings rates going up that high, which historically is where they were. If we get back to that situation, and we create, instead of creating zero domestically in terms of U.S. savings, up to 1.4, 1.5, $2 trillion as the U.S. economy grows, we're in effect displacing those reserves that are held overseas that we're so worried about. But again, this has to be a slow, natural transition and part of this global rebalancing. And if it is, it would come hand in hand with a change of the, of the Asian market, the structure of the Asian market. And again, not a bad thing. It's not a bad thing. If China and Japan, no longer need to hold treasuries, it also means that they're not going to have a need to suppress their currency. Now, Japan hasn't been doing that, but of late, China, of course, has. Other Asian bloc countries have, in order to compete with China on trade. But if China says all of a sudden we do let our currency start to go up in value because it actually helps the domestic market to have a stronger currency, we're not so export dependent, then you have a higher currency in China used by consumers that can import cheaper goods from the West. So that idea that at some point when China stops buying treasuries or starts to reduce treasury holdings isn't necessarily going to be a disaster scenario if we have this rebalancing in play. So there's two parts to this treasury question that you have to keep in mind. In general, this idea of muddling through on the U.S. side in the implicit weak dollar policy just means we have a resumption of the long-term bear market in the U.S. dollar. The U.S. dollar goes back down on the U.S. dollar index to 70, and maybe more if we get into a crisis scenario where it gets in trouble. And if this is the case, and it is an implicit weak dollar policy, which definitely looks like in play, we're juicing the asset markets around the world, and those are juicing the commodity markets. There's no reason the the Australian dollar, Canadian dollar can't continue to rally in here. Now, to us, the Australian dollar looks very, very extended, but it's a momentum trade in here. Every time it pulls back a bit, it looks like we're going to get a decent playable correction. The Aussie turns and just shoots up. Did it today. Didn't make a new high today, Australian dollar. Very, very close. Has not after hours at the moment. Canadian dollar is lagging. New Zealand dollar made a new high today, and the other commodity currencies in the developed world continue to rally. And if we are in this muddle through, if we are in an implicit weak dollar policy, and this wall of money keeps flowing offshore, and we continue to see some positive signs of growth, just a little bit in terms of exports, and the U.S. consumer doing a little bit less badly, this trend really could run. To us, the real play longer term through a weakening dollar policy, and even if the dollar on a growth standpoint, the emerging market currencies we like for a lot of different reasons. Obviously, if there's a risk bid, the emerging market currencies would get hit. But from a valuation standpoint, long term, if the growth continues and the capital gains opportunities continue offshore, some of the Asian currencies, not just the Chinese currency, which is not playable really, it's a pegged currency, but the others, 20, 30, 40, even 50% undervaluations against the U.S. dollar, and the euro, especially the euro here, probably even more against the euro given the rally in the euro. But long term, that whole Asian bloc, if they create a consumer market, is the place to be for low leverage, long-term trend trades. And I think as the ISE gets more and more depth, and more volume into their FX options, you're going to see more of these emerging market currencies come into play. Right now they have Mexico, which you can go out as long as 10 months on these, so it's something to consider if you think this is going to continue. The other part is the growth surprise, and this is idea that the U.S. really rebounds, and I explained it earlier, a heck of a lot faster than Europe, which is an open question now. Europe has actually been healing at a much better rate than we expected. So it's still an open question whether or not we get any type of growth surprise if the U.S. doesn't come out of this morass faster than Europe. I'd have to say in terms of scenarios, the implicit weak dollar policy is in play, number one. This is number two. We're not buying yet into a dollar crisis, but we're watching the treasuries very closely as a trigger. You've heard this idea the U.S. is going to be the carry trade currency because its interest rates are now lower than Japan and Switzerland. Makes a very good point. But if you look at the U.S. treasuries on a real yield basis, they're actually fairly high compared to its competitors. So there's real value, buying the U.S. treasuries with cheap dollars in here, given where they are, meaning real yield, meaning if you take the nominal yield in the U.S. treasuries and you add back in what would be the negative inflation rate in the U.S., the real yield in the U.S. treasuries is still very good, and we're still, despite everything, and despite all the treasuries being created, we're still seeing strong demand for U.S. treasuries and even international demand. When that changes, then we have to worry in a very, very big way. So if we see a growth surprise in the U.S., I think that's the time, and we'll probably start to see the dollar lead that and discount that to a degree, because when you look at the euro, at the level it's in now, it's probably close to 25 to 30% overvalued on the purchasing power parity basis against the U.S. dollar. We also have to believe if we see the U.S. dollar start to rally, the European governments will not be unhappy to see that because they're getting squeezed. When you think about Germany as a major export power, their currency is so high, the euro, relative to the U.S. dollar, and the Chinese currency, which is pegged to the U.S. dollar. So when the U.S. dollar goes down, Chinese currency goes down. So Germany has to compete against these two major blocks with a very, very high currency in terms of trade. So once this move starts, I'm sure it's not going to be something that the European governments are going to be worried about and very happy to see, and would definitely be a self-feeding type of move, especially now since the sentiment is so bad against the U.S. dollar. So we continue to watch this, but really at the moment we haven't seen any strong sign that the U.S. economy is going to blow past Europe, but it's definitely in play. And here's a shot of the euro currency on a weekly basis. Euro made another new high today. Trading right around 148 at the moment. Its all-time high was 160. So it's made a real power move here. It's gotten past that high that it went back to 147, just broke above that, and there's little resistance left on the chart here on the high side. So this idea of the U.S. in an implicit weak dollar policy, if it falls down, there, as much as from a fundamental and technical situation, the euro looks extended, it can run on a momentum trade, and it's something that unfortunately I've missed, trying to be too cute with my fundamental analysis and too cute with my technical analysis. And this is what happens in currency markets. They extend, they overshoot in a very, very big way towards the end of the trend. Unfortunately, we just don't know when it's going to end. So the play is go with the flow and don't get in front of the steamroller. I keep saying that to myself, but I keep getting in front of the steamroller. Anyway, those are the scenarios. I'll take some questions now. This is additional information on us. And actually, we do have some more on the ISC. Lynette, do you want to cover that? I just wanted to show this. This is upcoming seminars. I'll go through it, Lynette.
Hi, sorry, I just wasn't able to get to switch it over quick enough. But yes, feel free to go through it. Jack's webinar is going to be archived and available on ISC.com and on FXoptions.com, and so make sure to look out for it.
Thank you for participating in this week's session. Please join us again next week. Get trading ideas, exchange rates, webinars, news, and commentary. Visit www.fxoptions.com. ISE FX options can be easily traded through all options-enabled brokerage accounts.